Bryce Robinson with our last assignment, number 7, on the industry analysis. For our two companies, we have Medtronic and Abbot, and they are under the medical specialties industry. So in looking at our two companies and what industry fact set ratios were available for the medical specialties industry, we were able to determine that there are 12 ratios available in FactSet for our industry. So we have 3 leverage ratios. So the debt ratio, which is total debt to total assets for FactSet. The long-term debt to total capitalization, referenced in FactSet by long-term debt over total capital. Debt to equity, total debt divided by total equity. And then 6 profitability ratios: gross profit margin, gross margin in FactSet, operating profit margin, operating margin in FactSet, net profit margin, net margin in FactSet, cash flow margin, referenced as free cash flow margin in FactSet, return on total assets, and similar in FactSet as return on assets, and then return on equity, similar as ROE. And then finally, 3 market measures: earnings per share, EPS, PE ratio, referenced as price over earnings, and then dividend yield, dividend growth. For my section, in comparison, I have leverage ratios. And so the nice thing about all of our sections is that Medtronic and Abbot are in the same medical specialties industry, making our work a little bit easier. So for the first comparison, we have the debt ratio, in FactSet referenced as total debt over total assets. As we can see across the first line, both Medtronic and Abbot carry significantly more debt in comparison to assets than the industry average. Anywhere between 14% more on the Medtronic side and a little bit higher, 17 to 21% for Abbot. So Abbott's more so carrying more debt in comparison to assets than Medtronic, and much more so than the industry average. These higher ratios may mean that they are a greater risk to lenders, which could limit their borrowing capacity, or means that as a greater risk to lenders that they may have to pay higher interest rates to borrow money. That increased risk and higher debt to comparison to assets may also indicate limited money to save or spend, reducing their ability to make required payments in the future. The second leverage ratio is the long-term debt to total capitalization. In FactSet, that is determined by long-term debt divided by total capital. This debt to capital ratio is a liquidity ratio that measures a company's total liabilities against its total capital and refers to how much a company's operations are funded using debt versus capital. So generally, a lower number is better and indicates financial health of a company. As we can see across the board, Medtronic, Abbot, and the industry averages are all pretty much the same. So Medtronic and Abbot are functioning similar to industry averages. Medtronic almost right in line, and Abbot even a little bit less so. And so a lower ratio is better in general and indicates financial health of a company. So from an investor standpoint, a higher number would indicate greater risk. So for Medtronic and Abbot, pretty much in line with industry averages. Abbot even a little bit less so. Very different ratio of the long-term debt to total capitalization in comparison to the debt ratio. And then finally, the debt to equity ratio. In FactSet, this is determined as total debt divided by total equity. This is a measure of the degree to which a company is financing its operations with debt rather than with its own resources, its own capital. So again, generally, lower ratio is better, as this implies that the company is in less debt and is less risky for lenders and investors. So when we look across the board on the debt to equity ratio, Abbott's ratios are in line with industry averages or even a little bit better than industry averages, whereas Medtronic are significantly higher, about 20% more than the industry averages. So that would mean that Medtronic is using much more debt to finance its operations than using its own capital to do so. So as we kind of look at all three of those things, while Abbott has a higher debt ratio compared to the industry average, is its long-term debt to total capitalization ratio and its debt to equity ratio are actually better than the industry averages. So personally, if I were to pick between Medtronic and Abbott from an investment standpoint, I would go with Abbott. Thank you.
Good evening. My name is David Torres. I will be going over the profitability ratios in this section. First, and in this session, we will also be going over the gross profit margin, the operations profit margin, and the net profit margin for both Medtronic and Abbott. And we took the top 5 companies in the medical supply industry, which is the industry they fall into, and compared them to those instead of comparing Medtronic and Abbott one another. Yet, excuse me, I have another screen right here, so I will be looking out over here for numbers, but just know this is my main screen. So both companies did really well in these margins, and we'll go over them here. In gross profit margins, Medtronic and Abbott are significantly higher than the industry average, and especially in 2023. So we can see here, we consider I have 2024 numbers here just because colleagues also have 2024 numbers, but please note that we will be going over from 2021 to 2023 for Medtronic. So we can see here that Medtronic did really well in the comparison industry averages. 2023, 60,000. Sorry, 60%. 2022, 62%. 2021, almost 60%. Did that again. So on Abbott, we also have 2023 in 2023, we have 50%, 2022, 51%, 2021, 53%. And then we have your industry averages of 30% for 2023, 2022, 56%, and 2021, 44%. The only one that really fell a little short is 2022 for Abbott and 51% in comparison to industry average, but it's not that big of a difference. And now, why is this gross profit margin important? It is the number that we consider after cost of goods sold are considered in the equation. But this is before salaries and wages and before interest and taxes. So we definitely want to know how we're doing, from top and kind of go as we go down, making sure we're still doing great. And so far, both companies are doing really well. Now we have going to operations profit margin, and this is when we consider wages and income and into the equation and start looking at maybe patterns or things like that may be using a little more money than we should be. However, in this occasion, both Medtronic, Abbott, and Abbott are well above the industry average. We can see for the industry average, 2023, 2022, 2021 are all in the negative, especially 2023. So Medtronic and Abbott really are in a good spot in comparison to the industry average on the positive side. And they have consistent percentages on the operation profit margin. Now going on to lastly, which is the net profit margin. And net profit margin is considering all cost, the salary, income, cost of goods sold, interest, and interest and taxes. Apologize, and this is kind of just you know what they made the dough, I guess you could say. In net profit margin, we see that it also had the same problem as operation profit margin. Industry averages are well below the in the negatives, and so that puts Medtronic and Abbott in a really good spot to show that they are good companies to invest in because they make profit. They are well above the industry average. I hope this helps. Thank you so much for watching this section. I appreciate your time. Thank you.
The profitability ratios between Abbott, Medtronic, and the industry averages. So the first ratio we have is the free cash flow margin. And as you can see, Abbott and Medtronic both have way better cash flow margins than the industry average. In 2023, the industry average was negative 139.5. Compare that to Medtronic's 60.11 and Abbott's 49.96. Overall, if you look at the averages, Medtronic and Abbott are doing pretty good. The only positive industry average ratio would be the free cash flow margin in 2021, which is 6.30. As you can see, the return on assets, the industry isn't very good at having positive profitability relative to its assets. We can see Medtronic in 2024 at 17.71. It's pretty consistent. Abbott had 16.04. And if you look at the industry average, 2023 had negative 9.66. It was better in 22, but still negative at 0.88. And in 2021, it was negative 7.19. Return on equity is a little lower for Abbott and Medtronic, but it is still vastly better than the industry average. Excuse me. So Medtronic, as you can see, the percentage of profit a company, or specifically Medtronic, generates with the money shareholders have invested is 11.36. Abbott is 14.21, and the industry average in 2023 was negative 11.01. Now, there is an outlier, as you can see. The return on equity industry average in 2021. You can see that number is not very good at negative 191.59, showing that on average the industry did not use its equity effectively at all to generate earnings. I think partially this is due to COVID recovery, with especially in the healthcare industry, they were trying to recover from the shock that COVID hit. But as you can see, Medtronic and Abbott are definitely on the higher end of the industry when it comes to, frankly, free cash flow margin, return on assets, and return on equity, but especially return on equity in 2021.
Hello, this is AJ Bergen, and I've been tasked with analyzing Medtronic and Abbott's market measures, specifically EPS, PE ratio, and dividend yield against the industry averages. So first, Medtronic's earnings per share, the portion of a company's profit allocated to each outstanding share of common stock. Take these comparisons with a grain of salt. Obviously, we're going 2024, 2023, and 22 for Medtronic against the 23, 22, and 21 industry averages. But for EPS, Medtronic reported 277 this year, 283 last year, and 375 the year prior. Medtronic's EPS has been consistently declining over the past 3 years. The industry average for EPS in 2023 is 463, which is significantly higher than Medtronic's 277 this year. This trend suggests that Medtronic is underperforming in terms of profitability compared to the industry. It is important to note that Medtronic's reported EPS has been lower than industry average for all years in the data provided, not just 2024 and 2023. Abbott, on the other hand, not on the other hand, actually, they're also below the industry average. Abbott has also shown a steady decline as Medtronic, although the decline is less pronounced. Abbott's EPS for 2023 was $3.28, which was below the industry average of $4.63, showing similar underperformance as Medtronic when compared to the industry. Abbott's EPS also lags behind the 2022 industry average of $4.94 and 2021 industry average of $4.77. So both Medtronic and Abbott are underperforming relative to the industry in terms of EPS, with Medtronic showing a more significant decline. The PE ratio, defined as an evaluation, a metric comparing a company's share price to its EPS, reflecting how much investors are willing to pay for each dollar of earnings. Medtronic has also decreased slightly from 2023 to 2024, but remains higher than the industry average of 27.73 from last year. In comparison to the industry average, Medtronic's PE ratio for 2024, 28.79, and 2023, which was 32.14, is higher than the industry average of 27.73 in 2023. This indicates that investors might be willing to pay a premium for Medtronic stock relative to the broader industry, which might be due to just expectations for future growth or stability. Abbott, their PE ratio has fluctuated a bit more than Medtronic, reporting 33.56 last year, 27.87 the year before, and then 35.52 in 2021. The 2023 PE ratio of 33.56 is still above the industry average of 27.73 for 2023. Abbott's PE ratio is also higher than the industry average, like Medtronic, indicating that investors expect more growth or have greater confidence in Abbott's future performance. So both Medtronic and Abbott have higher PE ratios than the industry average, though Abbott has a slightly higher PE ratio than Medtronic. Lastly, dividend yield, the annual dividend payment as a percentage of the stock's current price, indicating the income return on investment. Medtronic and Abbott both have insanely high dividend yields relative to the industry average. The Medtronic reported 9.59% this year, 8.46% the year prior, and 9.06% in 2022. Medtronic's dividend yield has been steadily increasing from 2022 through to this year. Medtronic's 9.59 yield for 2024 is a lot higher than the industry average of 1% for 2023. This indicates that Medtronic is highly focused on returning capital to shareholders through dividends, possibly to compensate for weaker earnings and to attract investors, which through these other ratios shows that it is working. Abbott also reports high dividend yields of 6.09% last year, 6.77% in 2022, and 5.08% the year prior. Abbott's dividend yield has been relatively stable with a slight decline last year compared to 2022, though it is still much higher than the industry average of 1% in 2023, but not nearly as high as Medtronic's. Abbott's yield suggests a balanced approach to shareholder returns while still investing in its business. So Medtronic has an exceptionally high dividend yield compared to both Abbott and the industry, signaling a strong emphasis on returning capital to shareholders. Abbott's yield is also above the industry average, but it is more moderate in comparison to Medtronic. Thank you.